Hi, this is Helen Thomas and the CDFM study group. We're going to be continuing review of CDFM Module 2, Competency 1, Defense Budget Process. And I'm going to be picking up on page 2153. So in the last video, we reviewed the planning, programming, budget execution. We looked at the JCIDS, Joint Capabilities, Integration, and Development System. We touched a little bit on the defense acquisition system, remembering JCIDS identify capability gaps. If the capability gap requires a material solution, it triggers the acquisition system. If it's anything else, such as doctrine, organization, personnel, facilities, then you can go to the PPBE process. Remembering that all three systems, DoD support system, JCIDS, PPBE, defense acquisition system, all three systems overlap to meet the national defense strategy. So on page 53, now we're looking at specific appropriations. You have MILPERS, O&M, RDT&E procurement, and military construction. And we're going to look at each one of those. So the good chart is on the next page, which is page 54. And what you need to know from page 54, a few things. MILPERS and O&M are annual or one-year expense type appropriation. If you look, type of obligation period, it says 1 year, it says expense type. So that's both O&M and MILPERS are expense type. You have RDT&E, which is a 2-year appropriation, so multi-year. Procurement is a 3-year appropriation. And if you notice from the older study guides, they used to have shipbuilding, conversion, Navy as a separate entity. But now it's part of procurement, but you have to pick it out. So what am I talking about? On page 54, 2154, procurement, and if you go to the far right, it says 3 years, but it also says shipbuilding, conversion, Navy, which is a procurement, is a 5-year appropriation. So they did not remove it, they just put it in a different place. So you need to remember that shipbuilding, conversion, Navy is a 5-year procurement appropriation. MILCON is a 5-year appropriation, meaning they're good for obligation. Another thing I want to point out on this chart, operations and maintenance, O&M. You can use O&M funds to do construction project. What's the limitation? Minor construction up to $2 million. You can also use O&M dollars to procure, to buy things. The second bullet, under that one. If the cost of the system is not more than $250,000. So that has not changed. But that minor construction, that changed from older study guides. So ensure that you understand this chart inside and out, because it may come back to you in a form of, if I said today is, let's say today is 5 November 2012. I have RDT&E funds. When will these funds be expired? I'm asking you a lot of questions, but your knowledge of this chart will then determine, okay, if it's 5 November 2012, I'm actually in FY13. RDT&E funds are good for 2 years, so they're good for FY13, FY14. Appropriations expire for 5 years, and so forth. I got to add 5 years to that, so 15, 16, 17, 18, 19. And then FY20, those funds will be expired. So you have to be able to do that by knowing the timeline, the type of appropriation, and the timeline, remembering that we operate on fiscal years and so forth. All appropriations are good for a 5-year period after they are no longer available for obligation. So just because a fiscal year closes, let's say, all right, let's say we're in FY21, once 1 October comes and we're FY22, it doesn't mean that we don't have anything to do with FY21. So depending on the type of appropriation, as you know, you still have work to do with those appropriations for an additional 5 years. All right, so we should be able to go through the rest. 56, incremental. Well, we talked about annual. So did I skip annual? Yeah, annual on 55. We talked about O&M and MILPERS are annual. Incremental is your RDT&E, because as they go through the research and development, they get incremental funding based on where they are in the research. So an RDT&E is an incremental funding, and procurement and MILCON are full funding policy. Once you start that process, you got to complete it to get a benefit. All right, usable end items. Make sure you read through all of these terms. I don't see anything that really sticks out. Engineering and manufacturing, that's part of the acquisition, which we're going to learn in 2.2. Advanced procurement, sometimes in order for you to get the product when you need it, and mostly thinking about fiscal years, ending in a fiscal year, you might have to do an advanced procurement where you buy some of the items up front to ensure that you have a usable end item by the time you need it. Multi-year. Okay, so let's go to page 61, that chart. So this was alluding to what I started to tell you about the chart with the appropriations. Your knowledge of MILPERS and O&M being 1-year appropriation, you can use MILCON. For minor constructions, $2 million, you can use O&M. For procurement, $250,000 or less, you can use O&M. RDT&E being 2-year incremental. Procurement and MILCON being full funding policies. And investment type. Though all that knowledge, fiscal years, 1 October of 1 year to 30 September of the next year, will then help you to determine what phase an appropriation is in. So the practical exercise question that I asked you is based on all that knowledge, and then I can ask you, when do these appropriations enter phase 2? What is the period of that phase 2? Because all appropriation stays in phase 2 for 5 years. What things can I do with an appropriation when they're in phase 1? New obligations, adjustments. Phase 2, when they're expired. The only thing I can do with those appropriations when they're in phase 2 or the expired state is make adjustment, whether upward or downward adjustments. Phase 3 means the account is closed. ULOs, when we try to close out those ULOs of the canceling year that's coming up, is because once those funds are canceled, I can no longer have accountability of them. I can no longer use them to pay or make any adjustments. So those funds are returned to the miscellaneous receipts account of the Treasury. And so in phase 3, though, you have an exception to policy, and it's, let's see, they put it in writing. You can read through. Canceled, expired, canceled. Yeah, it's written also in, if you want to see it in writing, on the bottom of page 62. But in phase 3, when they're canceled, you have that 1% rule, which means if that bill comes in, invoice comes in on an account that's been closed or canceled, you can use up to 1% of current appropriation, the same type, to pay that bill. So you have the writing on page 62. Common obligating documents, meaning in order for us to obligate funds, we have to have an obligating document to do so. And common ones we use are the regular contracts, different types of contract, but contracts, and the MIPR, Military Interdepartmental Purchase Agreement request. That's the 448, DD 448. You can either, 448 can either be a project order, and project to me means it's long term, so I don't have to cancel at the end of the fiscal year, and Economy Act orders. And your Economy Act So I think this is mentioned. Let's see if it tells me. Module 3. I want to say module 3. It goes into more detail. The difference between, and remember, these exams overlap. So that's why it triggers my mind to go there. That you need to know the difference between a project order and an Economy Act order when you obligate and deobligate funds. And on the top of page 64, they have a good description here. Project order on the left, Economy Act order. Because the project order, once accepted in writing, is recorded as an obligation. Economy Act is we don't record it as an obligation until you get the MIPR acceptance. So most of the MIPRs that we do is Economy Act, an order that will produce a useful service by the end of that fiscal year. Unexecuted portion of the order must be deobligated when decided. So this is actually pretty good here to tell the difference between a project order MIPR and Economy Act. And usually a project order MIPR, those funds are tied to another contract. I send my funds on a MIPR, somebody else sends their funds on a MIPR, and then the servicing organization do one contract using those to do that project. Termination of contracts. Let's see, contingent liability. So contingent liability, let's go on page 65. No, I don't have my glasses on, I'm like squinting. Page 65, contingent liability simply means in some of the contract it's written that if the job is done by a certain timeline, certain date, that contractor will get an additional fee. So you can determine whether you obligate the full amount of the contract and the contingent liability or just the base amount of the contract. And once they earn that bonus or contingent funding, then you will get the funding from elsewhere. The next page, 66, goes into termination of contract, what happens to those funds. If I have to terminate the contract because of convenience of the government, that's usually written in the contract, meaning the government can get out of a contract if it no longer needs it. So that's usually no issue. The issue arises if I have a requirement, I have a contractor doing the job, but they're not fulfilling their obligation. They're not meeting the standards. As a contracting officer representative, you're reviewing their work and you're talking to the KO, contracting officer, and you're determining that they have to terminate their contract due to contractor default. Well, how do you get the job completed? A couple of ways. One, that KO will have to get a second contractor to complete the job or assess it, basically. If they can complete it with the remaining funds, then you have to do nothing else other than the KO getting another contract. However, if you have to exceed the scope of what was already approved, say the new contractor comes in and they have to then rip out everything the other guy did to be able to start from scratch to give you a product. Now, chances are the cost is going to exceed what was already approved, even to whatever that established percentage is. Once you start escaping the scope of approval, escaping the threshold that was set for the funding of that contract, then you have to submit a new request to get approval for that funding. It touched a little bit on foreign currency fluctuations at the bottom of page 66. Also, that for the DoD level, they keep that funding to deal with foreign currency fluctuations, to pay for bills at that level, dealing with foreign currency. Thresholds, fund alignments. Most of this is information. Let's see. At the top of page 70, that most can miss. So part of working capital funds on page 70 is the understanding of how that process works. So a working capital fund is unlike an appropriated funds where Congress appropriates funding every year. The working capital funds, they get funding when they first set up, they get appropriated funding to set up. But then after that, they use, commissary, for instance. The commissary gets money to initially set up. Then the commissary takes the money that they have to buy the food item, to buy the items to put on the shelf. Then based on how much it costs the commissary to put the items on the shelf, they put a price on the items in the commissary. So when the customer comes in, the customer selects the item, the customer pays for the item, and it revolves. That funding that you receive from the customer goes back in the business to then buy more items to put on the shelf, continuously revolving. So that's what the working capital funds are. And on page 2171, it's talking about the goal of the working capital fund is not to earn a profit. We're a government entity. So the goal of the working capital fund is to break even. So they go through how it works, the stock fund, industrial funds, and so forth. Page 72, 73 goes into some criteria for using the working capital fund. And I think they stay open. The working capital fund stays open until the purpose in which they were intended for has been exhausted, or then it's no longer needed. So somewhere in that writing, it should say that it stays in operation until the service is no longer needed. So the goal of the working capital fund is to break even. Funds management on 2174, Defense Working Capital Fund funds management. They have different types of schedules. So just because, what all of this is saying, just because they operate on a revolving basis, they don't have to go back to Congress every year to request additional funding. However, there's still guidelines, regulation, policies that they have to adhere to be able to stay in operation. Recording refunds received. You can read through that. Floor funds. Now the floor funds here goes back into that phase 1, phase 2, phase 3, where we talked about once Congress appropriate the money, you execute, commit, obligate, and you outlay. Instead of disbursement, you use the word outlay on page 2176. Outlay is when the official term for when the funds are removed from the treasury to pay for a bill. So upward, downward adjustments when they expired. So this is just the flow of funds are repeating what we discussed, phase 1, phase 2, phase 3 of an appropriation. Accounting for canceled authority. It talks about it there. It says what happens to the funds goes back to the treasury once those funds enter the canceled or closed state. So all that's what we went over. On page 78, that chart, you need to know what those words mean. So which means you have to understand the flow of funds. On a portion, so remember it's appropriate, apportion, allotment, commit, obligate, outlay. That's the order of the flow of funds. And I think at the end, it gives a chart. Let me check. And it gives an example in the first exercise. So make sure you look at it. I'll refer you back there. So on a portion means funds have been appropriated, but not apportioned. Unallotted apportionment. It means it's been apportioned, but it has not been allotted. Unobligated means it's been committed, but not obligated. Paid obligations. It's been obligated, I got the item, I paid for the item. Expired appropriation. That portion of the appropriation no longer available for new obligations. So that's the key thing there. And let's jump to page 21 what is that, 81. Make sure you go over this exercise so you can see how knowing the knowledge on page 78 would then help you to figure out if they said, what is the amount? They give you the totals, appropriation, apportionment, allotment, obligation, outlay, and then they say, what is the unapportioned appropriation? Well, I got to take what's appropriated minus what's already been apportioned to know what's not been apportioned. So that's a good exercise on page 2181 for you to understand the availability of funds. All right, so the last thing on this section is 78, let me see, 79 and 80 is the NAF funds, non-appropriated funds. So there are 3 categories of NAF funds. And we could just learn it from the chart here at the top of page 79, category A, B, and C. If that organization, that installation received category A funds, that tells you they get 100% appropriated funds, no NAF. If it's a category B, they get 65% appropriated funds and 35% NAF. Category C, no appropriated funds, and they get all NAF funds. And then you need to read through 79 and 80. They have some examples of what makes it a category A, B, or C, NAF funds. So that's the gist of what you need to learn here, is how much appropriated funds versus NAF funds, meaning they're MWR funds, where they raise the money, they charge you to go fishing, they charge you for bowling. Those are non-appropriated funds. Congress doesn't appropriate it, but they're allowed. So they have the ability to charge the customer to get the job done. All right, this look like this concludes CDFM Module 2, Competency 1, Defense Budget Process. So ensure that you subscribe, like, share these videos with other individuals who are studying to take the CDFM. Because it helps as you go through the material to hear it. And then with the videos, you can always repeat it, pause it, go back to the book to make sure you understand. Because the study guides does not include 100% of everything that you will see on the exam. If you notice in the study guides, you have lots of references that are given to you. The expectation is for you to review the references. So you might go in the exam and see something on the exam that you cannot find it nowhere in any of these study guides, word for word. It's possible. So what is in the study guide, you need to ensure that you learn the ins and outs of what you know in the study guide so that you will have enough information to be successful. So this is Helen Thomas and the CDFM Study Group. Thank you for stopping by, and I'll see you guys again next time.